Hey guys, how's it going? It's Nick here from Nick's Taxes, and I'm super excited about today's video because we're going to be talking about stock market investing for beginners. Now, in a previous video, I created a video talking about my 4 steps to generating wealth. And the fourth and final step of that is investing. So if you haven't watched that video, I'd encourage you to go check that out now and then come back to this video, because that's going to tell you everything you need to know to put yourself in a good position to generate wealth. In today's video, we're going to be talking about the basics of investing. We're going to look at what is stock market investing, capital gains, and dividends. So investing is basically putting money aside today with the expectation that you'll have more money in the future. And when I mean the future, I don't mean like tomorrow or next week. I'm talking about the long term. I'm looking at 10 to 50 plus years of investing. These strategies are not get rich quick schemes. These take time and patience and eventually pay out when you're at retirement age. So if you're watching this video and you're in your 20s and maybe you just got a job, I'm looking at investing for 40 years, so that way you have this money ready when you retire. Now, some think investing is very risky because they've heard stories of people losing it all in the stock market. But if you look at it from a long-term gain, investing isn't actually as risky as you might think. During the period from 1926 to 2015, the US stock market never experienced a loss within any 20-year period. Now, this includes the Great Depression of the 1930s and the 2008 stock market crash. Any 20-year consecutive period never saw a loss. Now, I want to take note that this is not for individual stocks on the US stock market. This is the US stock market as a whole. Basically, based on this data, if you invest money in the stock market for the long term, you're almost historically guaranteed to earn money. The other reason you want to do this for the long term is because you can harness the power of compound interest. Now, in order for compound interest to work, the magic ingredient is time. So the longer you have to invest, the more compound interest you can earn, and compound interest is essentially exponential growth. We'll talk a little bit more about that at the end of this video. Now, the other thing I want to point out is that the money that you should be using for investing in the stock market should not be money that you need to use in the short term. So if you're looking at like putting a down payment on a house next year or paying for college, you shouldn't put this money in the stock market. You should be putting this in some sort of savings account so you can have this money ready for you when you need to use it. Putting it in the stock market for the short term can be very volatile, and when you actually need to take that money out, you could be in a loss. So again, I want to emphasize that these stock market investing tips should be done for the long term. Now, the most popular form of investing is through securities, which is through the stock market, and this is where I'll be focusing my video. Now, stocks are also known as shares or equities. It basically just means that you own a piece of that company. Now, the most popular stock markets from where I am in Canada is the Toronto Stock Exchange, and also on the US side we look at the New York Stock Exchange. Think of Wall Street. A stock has no actual value. The price of a stock is actually the price that someone else is willing to pay for that unit of ownership. So that's why if you look at in the short term the stock market price really fluctuating, it's because the demand fluctuates over time. However, when we're looking at investing for the long term, we don't really care about these short-term fluctuations day to day. We want to look at long-term growth. So let's take a look at Apple, for example. Here's a one-day graph of the Apple stock. Now, you can see the price fluctuating a couple cents here, a couple cents there. Apple doesn't really do anything to make the stock go up or down like that. All that fluctuation is based on the supply and the demand of Apple shares during that specific day. However, if we zoom out and look at the long term, we can see this huge growth. And this is the long-term growth that I'm talking about and that I want you to be a part of. Now, if we look at the price of the stock at 2008, when the original iPhone first became popular, to now, we see this crazy amount of growth. And this is heavily dictated on what Apple did as a company. So on the stock market, you can earn money in basically one of two ways. The first way is through capital gains. Capital gains is when you purchase a stock now, and at some point in the future, the price of that stock is worth more. Now, the capital gain actually comes when you sell the stock at the higher price. You'll hear these terms unrealized gains, and that's when you still own the stock and it's worth more than it was when you originally bought it, but you haven't actually earned that income yet. Let's look at an example. So say you bought a stock for $2,000. That stock is now worth $3,000. You have a $1,000 unrealized gain because you haven't actually sold it, you haven't realized that gain. It's when you sell the stock and crystallize it that you've actually earned that $1,000. The same works on the inverse. If you bought a stock for $2,000 and it drops to $1,000, you haven't actually lost $1,000. You only lose the $1,000 if you actually sold that stock at that point in time. But if you wait, there's a chance that the value of that stock might appreciate. You might end up getting a capital gain in the future. For example, again, if we look at Apple stock, you can see there was a little peak and then the price of the stock went back down. If you bought it at that peak and sold it when it went down, you would have had a capital loss. But if you would have held on to it during that period of unrealized losses, you'll see that the stock trended back up. And if you would have held on to it for the long term, you would have seen some pretty good gains. Now, the second way to earn income on the stock market is through dividends. A dividend is a percentage of the profits from the company. Often dividends are paid quarterly, but some are paid monthly and some are paid twice a year, yearly. It depends on the company. There's no set rule for how or when a company should pay dividends. In order to earn that dividend, you don't actually have to do anything. You just have to own the share. So the more shares that you have, the more dividends you'll make. Now, it's important to note that not all stocks pay dividends, so it's important to do your homework before you make any sort of investment. Now, when you're looking, you'll see this thing called the dividend yield. So let's say, for example, you had that stock worth $2,000 and the company has a dividend yield of 5%. If that's the case, you'll earn $100 in dividends for the year. If the company pays dividends quarterly, you'll earn $25 for each dividend payment for a total of $100 for the year. So dividends is a great way for companies to encourage investors to invest in their company for the long run, because oftentimes these investors reinvest their profits back into the company. So the most ideal, I think, is to find companies that will both grow and pay dividends. So that way you're going to be getting the eventual capital gain and you'll be earning dividends along the way. Now, that's not always the case. Often stocks are separated into two different classes. You have the growth stocks and you have the dividend stocks. Growth stocks are a little bit potentially more risky and you earn the money from capital gains. A great example of this would be Shopify. Now, Shopify doesn't pay a dividend. They take any profits that they have and reinvest it back into the company in hopes of growing their company bigger and bigger. Now, for you as an investor, you'd like to have your capital gain appreciation be worth it, so that way you don't mind not having dividends because your capital gains are going to be substantial. And if you look at what Shopify's done just in the past 2 months alone, it's grown over 100% in value, making it very much worth not having dividends. Now, dividend stocks are known for consistently paying out dividends. These are often very big, well-established, blue chip type stocks that are basically staples in the economy or in the marketplace. So a couple examples here in Canada might be big bank stocks such as BMO or major telecommunication stocks such as TELUS. Now, they're not growth stocks because they're already so huge, it's hard for them to grow at the rate that a Shopify does, but they're still very profitable and they want to share those profits with you, the investor. Going back to the BMO example, BMO has been paying dividends since 1829, and they have a history of consistently raising their dividends. That is a prime example of the type of dividend stock you want to have. All right, so as promised, we'll look back at the compounding interest and what it means to have exponential growth. Now, the TSX since 1960 to 2018 has had an average annual rate of return of over 9%. And according to some people, the expected average rate of return for the future of the Toronto Stock Exchange is anywhere between 6 and 7.5%. So let's say, for example, right now we had $1,000 to invest, and we continued to invest $200 a month into the Toronto Stock Exchange. Based on those numbers, we'll assume an average yearly rate of return of 7%. If you continue to invest like that over the course of 30 years, you would end up having over $240,000. Now, I'll pull up the graph here and you can look at just how exponential growth works. You'll see those first few years, there isn't much of a difference, but the longer you invest, the more you make. You can see kind of around year 12 that you really start to see the exponential growth kick in and your investment income grow at a higher rate. Think of exponential growth like a snowball rolling down a hill. As it rolls, it continues to pick up more snow. And as it picks up more snow, the snowball gets bigger and bigger. And as it gets bigger and bigger, it rolls down the hill and generates more speed, making it harder to stop. Therefore, the snowball is increasing speed and increasing size as it goes down the hill. You'll see your investment chart kind of look similar, but in a growth perspective. Your money continues to grow in size, and those investments and those interests that you earn continue to become bigger and bigger as your principal grows and grows. This is why it's important to invest as early as you can and as often as you can. All right, that's my video on stock market investing for beginners. I hope you got value out of this video. If you did, please give it a thumbs up, and please let me know what you thought about this video in the comments below. I'm going to be making a lot more videos on stock market investing and other forms of investing in the very near future. So if that's something that interests you, please hit the subscribe button and please join me on this journey. So that's all for today. I'm Nick from Nick's Taxes. Thanks so much for watching. Take care.